Let's see what we got here. Oh, mailbox money.
Welcome to Real Estate Mailbox Money Part 2. The last time we covered triple net lease investing, most specifically single tenant triple net leasing, okay? In this edition, we're going to cover real estate private lending, or also known as hard money lending. So here are some of the advantages of why you would want to consider being a private real estate lender. Reason number one is you can get a much higher interest rate lending on real estate through private mortgages than you can earn what you earn in the bank. The bank is usually paying under 2% on a 2 to 3 year certificate of deposit. Yes, it's FDIC insured, but when you talk about 20 to 30 years, even earning slightly higher percentage interest can be drastic to your wealth planning strategy. Reason number two, the loan is secured by a tangible asset, real estate, okay? And also, you are in a secured position. When you invest in a bond in a company, you are pretty low on the capital stack. You come after senior debt and other financial obligations of a company. So if a company goes bankrupt, you're pretty low down the capital stack. You usually get paid out pennies on the dollar. So with real estate, if you're either doing a mortgage or a promissory note that's backed by the membership interest in the LLC that owns the real estate, if the borrower defaults, you are oftentimes in first position to take that property and also recoup your original investment. Reason number three is you are investing in someone you know. When you buy Apple stock or when you buy Apple bonds, do you really know the CEO, Tim Cook? When you are lending to a private individual, you typically will know that person. You have trust in that person. That person is available for a phone call if there's any issues or anything like that. Reason number four is the loan terms that you come to are completely customizable to your financial goals. Whatever you and a potential borrower can agree to, it's fully customizable, right? So you can make a real estate loan for as short or as long as you want. And the way you can do that is on the structure to begin with. There's some lenders out there that only want to loan out for 6 months at a time, okay? They just don't want to keep their money out in one particular loan that long. There are some lenders that I work with that they want their money to be on the street for longer so they have uninterrupted cash flow from those interest payments. So some of them, what they'll do is they don't want to be paid back in less than 3 years. So what they'll do is they'll build in prepayment penalties based upon the unpaid principal balance if it's paid any sooner than that 3-year period. Here are some things to know now that you know the advantages. Number one, there's a difference between a promissory note and a mortgage, okay? So a promissory note, which we've borrowed money through promissory notes, is not secured by a first lien position in the actual property. It is secured by a membership interest in the LLC. So that borrower defaults, there's mechanisms within that loan agreement where the membership interest will sweep to the lender, and then the lender will essentially take over that property, okay? The caveat with promissory notes is that if that lender puts a mortgage on the property while they have a promissory note on it, that can essentially wipe out your collateral position. So you want to make sure that you're protected and you're lending to the right person who's not going to do that. Mortgage is the tried and true way to be in first position at the top of the capital stack. That's the best way to be secure if security is your number one concern, okay? So make sure when you're forming your mortgage, there's attorneys involved. When you have a buyer or a borrower that is insisting on, we don't need to use attorneys, we can save on costs, we don't have to pay attorneys and that sort of thing, run away, okay? This should be done through an attorney that searches the title, does a title search in the property, and can guarantee your position in being first position and above any other potential lien holders on the property. So how do you find good real estate investors to lend to? Okay, my short answer to that question is going to your network. Okay, do you know any active real estate investors out there that are really, really, really doing well? Okay, those people that are rock stars. Go to them. Typically, you hear about this thing, buy real estate with no or low money down. Those deals are typically funded by hard money lenders or private money lenders. So go to those real estate investors that you know, like, and trust, and see how you might be able to help them in growing their business. Okay. The second approach is going to a real estate attorney. Most real estate attorneys have some experience in working with investors and will know of their clients, which ones are the most active. And also that attorney probably doesn't have a vested interest in referring some deadbeat to you. So that's the second place I would go. And then the third place I'd go would be realtors that you know. Realtors you know that work with investors and active ones. Ask them, hey, do you have a rock star investor that needs funding? I'd love to be able to help them. So that's a way on how to find loans, always through referrals. Never go, put an ad out in Craigslist or respond to to some random person on Facebook or something like that. So how do you vet the investor? First of all, I would have a meeting with them and make sure that they have good values and good reputation. Okay, there's a lot of charlatans in the real estate investing world. People that are, don't operate by the golden rule of do unto others. They operate by the rule of do it to them before they do it to you. So make sure that you're doing that in terms of vetting the investor. Also taking a look at how strong are they personally, right? Taking a look at their balance sheet. What are their assets? What are their liabilities? What are their financial commitments they currently have? Do they have any credit issues, right? Make sure to review their credit report. Make sure to have them fill out a personal financial report so you can see what those are. Also, do they have decent amount of cash to weather the storm? A lot of times, most of the time, things don't go according to plan when we're buying and rehabbing properties. So you want to make sure that they have sufficient cash resources and they're not, one small financial hiccup from an entire catastrophe that puts you in danger. Okay, so now that you've been able to vet the investor, now you want to be able to vet the collateral when you've found an investor you want to work with. Not every deal is going to be for you, all right? So you want to evaluate the risk of that deal, okay? Number one thing is that I don't like to lend, because I'm a private lender myself. I don't like to lend on any collateral that is in a low velocity marketplace where there's not a lot of transactions and people moving in and buying and selling and moving out. So usually that would preclude me from lending out in a rural area where there's a higher days on market. So you want to make sure what's the days on market for that property type in that little market there. Okay, so generally you'll be safe lending on properties that are around metropolitan statistical areas, right? So the core metropolitan area and probably the suburbs. Once you get outside there, it becomes higher risk, okay? So that's one way, one important thing in evaluating the collateral. Secondly, what is the property type? Is it something that is odd? Like, I wouldn't lend on an amusement park. There's not a lot of people buying amusement parks lately. Churches, schools, any property that's like when you walk through it, you're like, what are you gonna do with this property, right? So make sure you're vetting the collateral that way. Also, what is the investor buying the property at versus what it's worth in its as-is condition, and also its after rehab value or ARV. You can get this opinion either through your own experience, if you're an experienced real estate professional or a realtor yourself, or if you don't have any idea as to what this property might be worth, get a third-party, non-biased opinion. I have some private money lenders that require me to pay for an appraisal or a broker price opinion on a property before they lend on it, so they know, all right, what is the value of the property? What's the after rehab value of the property? So what do you do if you want to lend on real estate, but you don't have a ton of cash laying around, right? So there's options for that, right? I don't use really most of my own cash when I do a real estate deal. I act like the bank. I borrow money at a lower interest rate and lend it out at a higher interest rate. Sound familiar? They pay you 0.2% interest and they lend it out at 4, 5, 6% interest. So what you can do is if you have other investments, other marketable securities, your broker, for instance, your investment broker has credit line facilities, or should have credit line facilities that allow you to take a loan out against that collateral and pay, let's say, a floating rate of between 3 and 4%, and then you can lend it out at whatever rate that you agree to with your buyer. Okay. You also have cash value with whole life insurance policies. There's a lot of lenders out there that use those. And then also, lastly, there's also some community banks that will allow you to lend based upon the collateral of loans you already have in your mortgage portfolio. So you can lend out $100,000 and then get back $80,000 when you close on that loan that you can lend out again. That is a great way to grow a loan portfolio if that's what your plan is going to be. But those are some options. You don't have to have all of the cash in order to do that. Some people use home equity lines of credit. Okay, lastly is how to price your loans. Like I said, private real estate loans can range anywhere from 7% to 16%. So why don't I just lend it out at 16%? The issue with that is that your borrower is going to be, based upon their experience and their track record, is going to be very sensitive to interest rates in their deals, right? So they usually probably have already relationships with private money lenders. So 16% may never work for them. All right. So there's going to be a balance between the risk of the deal and also the risk of the investor. So let's say a rock star investor with a rock star track record is probably going to pay on the lower end of that range. A junk borrower with a junk property is going to expect to pay a higher interest rate on that. But that being said, you probably want to be working on with better people, better properties and opportunities, because at the end of the day, you don't want to lose money and you don't want to be in the business of owning property. You want to be in the business of earning interest on property. So I hope all this has helped. Please go to our blog to read this. That has much more information. Also, be sure to check out our upcoming boot camp called Go Big or Go Bigger, how to buy your second, third, and 100th rental property. This program is all about scale. So if you want to scale your real estate portfolio and earn financial freedom, this is going to be the opportunity for you. It's going to be myself, Marty Grisanti, and his partner, Matt McGuckin. We're going to be doing this in Rochester, New York. So please be sure to sign up for that at gobiggobigger.com. And you can have our link to the Eventbrite for the tickets are on that. So thank you very much for tuning in and have a wonderful day.